So I'm at the beginning of writing my quarterly, and in doing that, I have a broader outlook for commodities prices, which I do first, and then I get into the individual commodity prices, and we'll be doing those models over the next couple of weeks. What I wanted to talk about this morning is how the commodity price cycle turns. And the two charts that I've got are to deal with growth in international reserves. Firstly, the growth in international reserves, which is what you've got here, and the level of international reserves, which will be the next slide. The original work on the relationship between international reserves, commodity prices, and inflation was done in the 70s and the 80s by the International Monetary Fund, because that's when inflation was really high and oil prices and other commodities were really booming. And they were done, but it was basically done by a team headed up by Robert Heller, who was Chief of Research of the International Monetary Fund. Now you'd call him Chief Economist, I guess. And he was in the job for the longest period that anyone was able to do until this century. We had a guy called Olivier Blanchard, which was regarded as one of the best living economists never to win a Nobel Prize. But Heller noted the relationship between the growth of international reserves and worldwide inflation. So the big boom in inflation of the 70s and the 80s was because of that big boom in growth in international reserves, which you can see at the beginning of the chart. It occurs in the 70s, and then it occurs again in the late 80s, and there's a surge in inflation at that time, which generates a big sell-off in bonds, which generated a thing called the 1997 stock market crash. But right now, we're going through a period in time which has been extremely deflationary, in which growth in international reserves has been the lowest since Paul Volcker was in the Federal Reserve back in the early 80s. And that's because of rapid tightening of the Fed funds rate that we've seen under Jay Powell, not to anything like the same levels as Paul Volcker did back in the 80s, but probably as rapidly, or if not more rapidly than Volcker did. And what that's done in the first slide is it generated a slump in international reserves to minus 9% in 2022, and that was the lowest growth in international reserves since Paul Volcker was in the chairman of the Fed back in the early 80s. And what that means is that generates a generally deflationary international environment. And what you can see, in spite of all of the spending that Joe Biden and the Biden-Harris administration has done, really inflation is falling. Inflation is falling in the US, and it's falling in Australia, and it's falling in the euro area. But it's also taken commodity prices down with it. And that's not what Australia is interested in. Australia is interested in higher and rising commodity prices. And what we can see when we look at the rate of growth is the rate of growth has bottomed and has kicked up to 2.5%, which is still low because the long-term average is 9.7% and the long-term median is 7%. So on the balance of probability, you definitely expect, if nothing else but the balance of probability, you'd expect this to dramatically accelerate from where it is. And as it dramatically accelerates, what we see is that the rate of growth of total international reserves leads Australian commodity prices, by which I mean the components of the RBA index in US dollar terms, by 4 to 5 quarters. So as this accelerates, commodity prices will go up. And it also leads Australian and US inflation by about a year longer than that, let's say. So if we look at where this growth pattern is, we can see that right now we should be at the bottom of the commodity cycle, or this half of the year we should be at the bottom of the commodity cycle. And we've seen that when we look at some of our commodity models, and I'll show you the way we do this series in the commodity prices. We move to the other slide. Okay. So during the week, a long-term client of the firm rang me and asked me to do some soft commodities, not hard commodities, things like wheat and cotton that he was interested in. And what was really interesting to me was that when I ran those models, all of those commodities looked about a standard error too cheap. That is to say, they'd suddenly become, over the last year, they'd become outright buys in terms of the model. And the component of the models that's in our commodity models that makes that happen is not the rate of growth of international reserves, but the level of international reserves. And we can see the level of international reserves on this slide, and we can see how it fell really savagely in 2022. And so by the end of 2022, you've got quite a dramatic decline back to about, at a total level, down to about 12 trillion US dollars. Now, where these numbers come from, they come from the International Monetary Fund, and they're published in a summary called Currency Composition of Official Foreign Exchange, or COFER, and that comes out every quarter. So what happens is that since that low at the end of 2023, international reserves have been gradually rising. And like I say, they're only going up at the rate at the moment of 2% a year. But as they rise and commodity prices don't, or commodity prices are soft, what happens is the model shows that they're getting, the price is rising relative to the equilibrium price of the model is rising higher than the actual levels. And so what we see is these commodity prices, these international reserves, should move sharply higher between now and the end of 2025, and that will lift our commodity models. So what I'm saying is, in terms of the general outlook, this half should be the bottom of the commodity price, and then you should have a multi-year period of rising prices. If you want a short-term signal of what's happening in the commodity market, look at the DXY. In my experience, the DXY tends to lead commodity prices by about 2 to 3 months. And it just so happens that if you look at the DXY, it's been falling for the last couple of months. Now, the DXY over the last 4 years has been doing broad cyclical patterns up and down in a sideways direction. But I expect that what's going to happen over the next year is as the Fed funds rate is cut, then the DXY will cycle down to lower and lower levels going forward. That is to say, the US dollar will fall and commodity prices will go up. But the general outlook is for improving commodity prices and commodity reflation from here. But if you want a short-term leading indicator, look at what the US dollar is doing. And the DXY seems to lead commodity prices by about 2 months.